Let's take a look at property, plants, and equipment. This is also known as fixed assets, sometimes called non-current assets, although non-current assets also include other types of assets, such as intangible assets, which we'll talk about in Chapter 12. But Chapter 10 essentially deals with what is property, plant, and equipment. And excuse me, if you look at the balance sheet of any publicly traded company, what you're going to see on the balance sheet is something called long-term or non-current assets. And most likely what you'll see there is something called net PP&E. And the PP&E stands for property, plant, and equipment. And it's called net because what's reported at the face value is after depreciation, after accumulated depreciation. So it's original acquisition cost less accumulated depreciation is net PP&E. So what Chapter 10 talks about is the acquisition cost or the gross cost of PP&E. And then Chapter 11 talks about the depreciation aspect of it. And when you put the two together, you have net PP&E. And certainly for internal reporting, you break out the details in much more elaborate form. But in any case, what this chapter is going to talk about is the acquisition and disposition cost related to the property, plant, and equipment that for some companies is a significant portion of their overall cost structure. So let's first talk about what property, plant, and equipment is. They're assets that they're durable. That is, we can see them, touch them, sometimes move them around. They're sometimes called plant assets or fixed assets. They're used in operations and they're not available for resale. Long-term in nature means that they can, we expect to get at least a year or more from them, often much longer. And we also, they have physical substance. So some examples: land, building structures, equipment, etc. So the other thing about fixed assets is we typically depreciate them. There are some exceptions to that. In particular, land is not depreciated, but most of these other assets, we have some form of depreciation that goes on. And we'll talk about depreciation in the next chapter. So essentially what happens with that property, plant, and equipment is it's stated on the books almost always at historical cost. That's the price that we paid for the particular asset or the price that we incurred to create the asset. And the main reason for it under generally accepted accounting principles, it's reliable. And companies typically don't anticipate, nor do they take any gains or losses, but there are some exceptions, as we'll see, particularly with regard to losses, but also in some cases with gains. Talk about the cost of land, what's included. So it's not just the purchase price of the land, we can include these other items as well. Closing costs, cost of fixing up the land, if we assume any liabilities, and any additional land improvements that have an indefinite life. So sometimes there's some infrastructure work that goes along with land, maybe related to water or some environmental issues or some other issue. But in any case, all of these can be put in the land account. And the land account, unlike the other property, plant, and equipment accounts, is not depreciated. That said, there is something called land improvements, which is depreciated. These are things like sidewalks or fences, or parking lots, and they're depreciated because they have a short or definite life. And so as a result, we can depreciate them over the useful life to the business. But the land itself is not depreciated. So when we talk about buildings, which can be a large portion of the property, plant, and equipment accounts, there's two ways we can acquire buildings. One is that we can build it, and the other is that we can purchase it. So if we build it, we can include all expenditures related to directly its construction and acquisition. So it includes material, labor, overhead incurred during construction, and professional fees and building permits. So if I buy a piece of land and I hire somebody to build that building for me, then I can include all the costs related to that particular activity. With regard to equipment, so it's the purchase price purchase price plus any freight and handling, insurance, while in transit, cost of special foundations if required. I worked in the semiconductor industry for many years and would often have to retrofit a portion of the building to put these large pieces of equipment in. That would be added to the cost of the equipment, any assembly and installation costs, and also the cost of trial runs, which in some industries can be relatively extensive and expensive. So here's some specific examples around which accounts should be used for certain activities. Okay, you can read through this. Okay, but basically we should recognize that which activity goes to which accounts. And here's some more of the same. So let's look at the accounting issues related to self-constructed assets. So one of the problems is interest cost during construction. So 3 approaches have been suggested to account for the interest incurred in financing the construction. Capitalize no interest during construction, capitalize actual costs incurred during construction, and capitalize all cost of funds. So GAAP requires capitalizing actual interest with modification. So it's consistent with historical cost. It considers 3 items: qualifying assets, capitalization period, and amount to be capitalized. So the qualifying assets require a period of time to get them ready for their intended use. 2 types of assets: assets under construction for company's own use, assets intended for sale or lease that are constructed or produced as discrete projects. We're basically talking about the interest cost here. So capitalizing interest begins when expenditures for the assets have been made, activities for readying the assets are in progress, interest costs are being incurred, and ends when the asset is substantially complete and ready for use. So capitalize the lesser of the actual interest cost or the avoidable interest cost, and that is the amount of interest cost during the period that the company could theoretically avoid it if it had not made expenditures for the asset. Here's an illustration that you can read through. Okay, step 1, determine which assets qualify for capitalization, and then step 2, determine the capitalization period. Step 3, compute the weighted average accumulated expenditures. And step 4, compute the actual and avoidable interest. Okay, fairly technical accounting issue that you may have to deal with at some point. Capitalize the lesser of avoidable interest or actual interest. So a multitude of ways that I might acquire property, plant, and equipment. I might pay cash for it. This is typically, or I might exchange assets for it. So this section talks about how to value the property, plant, and equipment I acquire through acquisition. So the goal should be to record property, plant at the fair value of what was given up or the fair value of the asset received, whichever is more clearly evident. So we have to recognize cash discounts given, deferred payment contracts. So if we have a deferred payment, then we have to use the time value of money to bring it back to the present value. Sometimes we have a lump sum purchase where I buy several things from a company. So in that case, I have to essentially look at what I've paid them and then probably do some appraisal of the different assets and apportion the cost related to the appraisal of the different assets. Sometimes I give up stock. And so generally speaking, the market price of the stock is a fair indication. But again, if it's a lump sum purchase, then I have to assign the value to the various assets. I could also give up non-monetary assets. So, exchange, a trade-in or so forth. So ordinarily we account for that on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is more clearly evident. So the other thing is this term commercial substance. So companies should recognize immediately any gains or losses on exchange when the transaction has commercial substance. So let's take a look at what that means. Exchange has commercial substance if the future cash flows change as a result of the transaction. So cash flows are a very important issue when we look at an issue called impairment, which we'll look at in the next chapter. But if we expect the cash flow of the business or the economic positions to change, then we're going to end up with either a gain or a loss. And in that case, what we want to do is segment that into either a gain or a loss. And we'll recognize those gains or losses immediately. So companies recognize a loss immediately, whether the exchange has commercial substance or not. So if we know we've had a loss on an exchange, and the rationale here is companies should not value assets at more than their cash equivalent price. If losses were deferred, assets would be overstated. If we have a gain, then what we want to do is, again, put the asset on the book at its fair value. We don't want to overstate its value. And then if there's something above that that we've received, we want to recognize the gain immediately. So here's an example. And if it lacks commercial substance, no cash received, then if there is cash received, then when a company receives cash in exchange for lack of commercial substance, it may immediately recognize a portion of the gain. And this is a relatively complicated formula too. You'd have to look up to figure out how much gain to recognize. Many times we incur cost after we've acquired something. So generally speaking, costs incurred to achieve greater future benefits should be capitalized. If they increase the useful life of the asset involved. If they're simply ordinary maintenance, then we're going to expense them. So in order to capitalize, one of the three conditions must be met. Useful life must be increased, the quantity of units produced must be increased, and the quality of the units produced must be enhanced. So if it meets one of those three criteria, then the expenses that you've incurred to improve a particular asset can be capitalized. It's always more conservative to expense something. So if in doubt, you should expense things because you don't want to overstate the value of your assets. Here's some examples: additions, improvements and replacements, rearrangements and reinstallations, and repairs. So repairs typically are things that we're going to expense, in my opinion. These others, if they meet the criteria, then I would consider capitalizing them. So here's an extreme example, we hope. And certainly during the early portion of the 2000s, we had several companies, Enron, WorldCom, and several others where there were different types of accounting practices that were really fraudulent. And so WorldCom actually used property, plant, and equipment as a basis to essentially defraud investors and creditors and keep their stock prices high. And what they were basically doing was putting expenses onto the balance sheet as property, plant, and equipment. So if you read through what do the numbers mean here, and then you can see in this next slide, WorldCom's accounting, basically they overstated the value of their property, plant, and equipment, so they deferred expenses, right? Eventually they would hit the income statement, but over a very long period of time. And so what the auditors found that in 2001, they reported income of 1.38 billion. Had they done the proper accounting, had they expensed things properly, they actually would have had a loss. So what happens is that investors and creditors, not knowing that these activities are going on, think the company is much more profitable than it is, and continue to invest in it, continue to loan it money, and eventually So with all assets, whether it be inventory, property, plant, and equipment, one of the roles of the accounting profession is to follow the generally accepted accounting principles and be diligent, because you have the opportunity to make sure as a referee in the game, to make sure that things are reported fairly and properly. And when you step over the line, as the WorldCom accounting professionals did, you become part of the team, and you do things inappropriately, it can have very serious repercussions. So the last thing talked about in Chapter 10 is the disposition of property, plant, and equipment. So a company may retire plant assets voluntarily or dispose of them by sale, exchange, and conversion or abandonment. Depreciation must be taken up to the date of the disposition, but not any longer. Okay, so here's a sale of a plant asset up to the date of disposition. The money received, and you either have a gain or a loss on the disposition. Sometimes an asset service is terminated through some type of involuntary conversion, such as fire, flood, theft, or other. Companies report differences between the amount recovered and the book value as a gain or a loss. So it's treated like any other disposition. And here's an example. Okay, so we're going to move on now to Chapter 11, and that is going to deal with depreciation and something called impairment, and that will be in the next recording.